Hello and welcome to a special edition of The Download. I'm Dave Richardson and I'm here with Stu Kedwell. It is Thursdays.
Yeah.
And if you're wondering, this is the first time you've ever seen us side by side. A lot of people thought that we never talk. We're actually one floor away from each other in Toronto. Very rarely see each other there. So we came to London, England to actually be able to connect. This is the second of two special editions that we're doing. With the announcements from the U.S. President Donald Trump of tariffs applied to 180 different countries. If you want to hear more of a focus on the economic impacts, or what Eric Lascelles, our chief economist, was thinking about the announcement yesterday and the impacts, please go and listen to the other special edition. In fact, subscribe. And you'll automatically have that podcast dropped whenever we do a special edition. But Eric was talking a lot about the idea that with all of this around the tariffs since Trump's election, through the campaign where he talked about tariffs, that nothing has been a given, nothing has been overly predictable, and once again this was a bit of a curveball. But you could actually go back and look at countries and their specific trading relationship with the U.S., and you could almost have calculated where this tariff was going to come in. And of course, this is the initial announcement. So, like a lot of the announcements around tariffs, this may not be the end of it. In fact, it may be the big bazooka. This might be the first announcement, and then we move back from there. And we're going to touch on that, I think, Stu. But one of the biggest surprises was the extent to which Mexico and our beloved Canada was left to the side, and Eric muses on a few of the reasons for that. So I'd encourage you to go to listen to that. But let's talk to Stu, because Stu is who we talked to, and Stu is the co-head of global equities at RBC Global Asset Management, and we always like to get Stu's perspective from what he's doing as an investment manager in portfolios, or how he's thinking about how these announcements impact the decision making and the scenario analysis that he does as a portfolio manager, and what you as an investor, either investing through someone like Stu or trying to invest on yourself, how you digest this information and react to it. So Stu, what are your thoughts as we have the announcements yesterday?
Yeah, thanks, Dave. So it was different. It was different than people thought it was going to be.
Yeah.
We were listening to the press conference last night, and it was definitely a unique press conference. The way that some of the tariffs were, calculated was a little bit of a surprise in some of the countries that it has ended up hitting, and particularly, some of the impact on some U.S. consumer stocks that import from a variety of areas. I think the second thing is the level of exemption. There's some question mark around that. So, already there's, depending on how you interpret it, maybe a third of U.S. imports might be exempt from some of the tariffs. And will that list, change going forward? So to your point around, is this the opening salvo? It's hard to think that it gets magnitudes of here. So this is, some beginning of a negotiation. The second thing is, we like to get in a couple of things. All the discussion we've had around tariffs has strengthened the U.S. dollar, and today it's weak.
Yes.
That is a big change, and I think there's fundamental value and there's capital flow in the near term, and with the U.S. market weakness today and the U.S. dollar weakness, for a non-U.S. holder of equities, the decline is magnified. And that can contribute to deleveraging and all sorts of things. So, so watching currency react. The second was looking at the 10-year bond. Given that this is likely a negative for the economy, the 10-year yield is down, so bonds have rallied, but maybe not as much as you would have thought otherwise. So, so those two things, like before the market opens, you've kind of taken note of. And then what you're trying to do when the market opens is, areas that of the market that are a bit more economically sensitive are going to get hit a little bit harder because the market is trying to handicap the possibility of a slowdown in earnings. so you're just kind of watchful for that. Many people like to look at the first half hour of trade and see, do we make a new low after the first half hour? These are just, kind of, in the day, type things. The second thing is that, some areas of the market that are viewed as defensive, they start the day up. And, I think inside of a portfolio, just buying a defensive stock because, which is already at an elevated valuation because of a slowdown, that's not something that, we often do, that often. And then, and to your point, Canada has fared better amongst domestic oriented names. So like some of the domestic banks are better than U.S. banks and things like this. When you get into scenarios, it's not a new analysis. It's just a refreshing. So the first thing that happened is, a meeting at 8:00 this morning on the team and, running through every sector and, what could be the possible implications of this and how, what scenarios do we need to go refresh and, be aware of. And then you're trying to find, stocks that are getting close to, that more bearish case. We're finding stocks that are getting there. The market as a whole is a little bit more challenging because while estimates are coming down, they're quite sensitive to the actual growth of the economy. And with some of this tariff activity, it does lead to the possibility of lower economic growth. So, you have to kind of resize, some of the broader market, type assumptions. But, all that said, when you get weakness and it could persist, we had discussed last time that the quality of the rally was not, really,
that's right,
wasn't really great. So now we're at new lower levels and trying to turn this volatility into the friend of the longer term investor is something that very much is still the case for us.
Yeah. So you so a couple of things that we talked about, and when went down, I was in your office earlier, and we looked right away at did we hit a newer low, and that we did go down to another low. So now it's a question of where we put in the next low, but the whole idea, and when I said the bazooka, and we talked about this, it's the first salvo, but you would think, and what you think sometimes doesn't end up coming to pass, but you think you start out very strong. At least that's been the negotiating tactic that he's used on a number of fronts over his many years in public life, that perhaps this is the worst. And we've talked about how sometimes things are really bad, but then when they're really bad, there's kind of only one direction they can go, and they could still be bad, but not as bad. And each adjustment might help settle things down. And again, at least, well, actually, would you say that we have more certainty in the market after these announcements because it helps us understand some of the thinking around the tariffs, or are we still out in the woods to a large extent?
Well, there's more certainty because he's detailed the mechanism, which was a little bit different than what people thought. Yeah. Then the other side to it is the uncertainty around the estimates of the significance you could drive a truck through. Some economists are saying, when you look at the impact, and then you have about a third, pharmaceuticals, perhaps semiconductors, other goods that are going to receive an exemption, that the impact, might be around, 13% or something like this. And, I think a lot of people have been in the kind of 10 to 15% neighborhood. Without exemptions, you'd be closer to 18. Some people have estimates even higher. It's a bit of a moving target. And your question around the negotiation is, will the exemption list expand? Is something that we need to pay careful attention to. And in the area that we're most focused on there is on many of the U.S. consumer companies that are importing products largely from Asia. And will some of those get exempted? Because those share prices have borne the brunt today. So we'll have to kind of pay careful attention to that. The kind of, you're getting commodity weakness around potentially lower global growth. Commodity weakness is a bit more of a straightforward playbook because, you can kind of resize the new level of growth, and you can say, well, this is the commodity price that'll endure in that environment, and we can go look at the stocks on that basis. I think the other thing too is many of the commodity businesses have much better balance sheets than they may have had in similar type cycles. So that's definitely a positive as well. But I would go back to, like, when you see movement in the currency market, like we've seen, I think that is the signal of uncertainty in this instant. If we had it all buttoned down, I'm not sure the currency markets would have necessarily swung in quite the same manner. So it's going to be a very active environment for analysis in the coming days and weeks.
And because of that uncertainty, do you take any action today, or as you said, you've seen a lot of action in markets where it's almost a move to a very defensive type of stock.
Yep.
But you've seen the valuation on those defensive types of stocks shift up, so they're just not as attractive, maybe even completely unattractive. So that's not a place you want to go to hide at this point. But is there anywhere where you're looking around and finding opportunities, or is this a day where you just want to sit back and analyze what's going on and then maybe look at something a little bit later?
Yeah, so I think the two things that you're always thinking, or three things you're always thinking through in the portfolio, just as an equity portfolio, we do have some cash.
Yep.
So putting that cash to work. Then the second is we have many of these defensive names. Is the spread in valuation between a defensive name and something that might be a little bit more cyclical too wide? So we do have a time horizon. Should we act on that? And then within sector, you often look at like two defensive stocks or two more cyclical stocks that are reacting differently today than you might have thought, and maybe there's opportunity there. So those are the three major decisions, the buckets of decisions that you're going through in the portfolio. And then at the asset allocation level, obviously you're looking at the change in the bond market. So in a day like today, while the equity market is selling off, the bonds are rallying. So do we want to do some rebalancing on that front? And that's kind of more of an asset allocation decision that you'd look at today. I would say in this environment, your thought process is very fluid, and it is a period usually of activity.
So this is a day where you and the team are relatively active, not only from working, analyzing, doing the calculations, crunching the numbers, but actually in market making moves.
Yeah, and I expect that will likely continue. I think volatility, going back to the part about the quality of the recent rally, I think volatility is likely to remain a little bit higher, and activity is likely to remain higher as a result. You don't come to work each day saying I need to change my portfolio, but the puzzle pieces change, and sometimes it's significant on a day like today. You're likely to make some changes that you think are improving the odds of longer term success.
Yeah, so a few points come out of that as we sit where we are today. One of the things that was amazing to me, again, I'm in the business, but I don't often get to walk the trading floor, and I'm not walking the trading floor to look at anything specific that anyone's doing, but I'm looking more for the tone. I'm looking for how are the individual investment managers. What do their emotions look like? Is it? And then I think too, when I was advising customers many years ago, and I'm still out with customers and advisors from time to time, and just the absolute, it was just a very, very calm environment. And people are working hard, as you say, because the activity's there, but there's just no emotion in the calculus, right? It's just a straight, okay, this has happened. This recalibrates. We might need to reposition some things, but it's all about where are the opportunities, and it's not geez, we got to get out of this because it's down 5%. It's more about, okay, is this something we need to continue to hold, or is this going to go down more? If not, we might hold on to it. Might even add to it. It's just it's amazing. This is what I wish most investors could see, is just the behavior and the personality, the way investment managers react. And you can see, look at him. He's not even. It's kind of hard. I'm trying to draw a reaction out of him from time to time, which I don't often get. But it is kind of amazing, right? Like this is the way you guys are wired.
Well, and it's very iterative.
Yeah.
and you know that it's going to be iterative, and you know that there ultimately there'll be opportunity that finds its way out of this. So, you know, you have to, you know, there's times where you get, you know, focused on, you know, trying to capture the last part of a move, and there's times when you have to think about, well, where is the next big move? And you know, so when you make decisions, you have to kind of be honest with yourself. Like, what am I doing? Am I doing one or the other? If I'm doing something more short term, then I have to have a different playbook. But you know, we've seen uncertainty rise. We've seen stock price change. We haven't quite seen a full valuation change relative to the uncertainty rise, but uncertainty rising, valuation improving is you know, something that eventually we want to lean into.
Yeah, and then if so, when you look at the professional investor, a little more active. We've talked about the idea that there'd be more volatility this year. So here's another example of that playing out, and we've seen that through the first 3 months plus of this year. We've talked about the portfolio and the importance of that bonds could play as a counterbalance or insurance against that equity volatility or downside in equities. And again, that activity level for you with a group of professional investors, and you're moving big portfolios, different stocks, different bond holdings. But for an individual investor at home who's maybe using one of the investment funds that you manage, or using a portfolio solution that Sarah Riopel, who's a guest on the podcast, she's managing. So for you, it's a day of activity. Do you think it's the same though for an investor saving for retirement 20 years from now?
Yeah, no, I think it is. Like, it's like the things that we know. Long-term earnings growth is not very volatile, but share prices on any given day can be volatile. So, you know, we're just in there, you know, looking, you know, how do we attach ourselves to, you know, even better long-term earnings growth that, you know, eventually will find its ways. You know, business with tariffs, there'll be some restructuring, but, you know, management teams, you know, all the same discussions and questions that you're asking, management teams are having about their business, and they're coming up with new plans. And you know, that is the option that the equity investor gets, particularly in the midst of a concerning period. That you know, business will find new ways to make money, new markets, reorient their business, and what have you.
Yeah, and so any strategies that you can think of for
well,
that maybe you've been recommending for a while, and then you can kind of say, "I told you so" on it right now.
Yeah, like we've been obviously we're the dollar cost average boy.
There we go.
he can be in Toronto, he can be in London.
That's right.
He's
quite popular here in London. I saw you your tights running around the palace this morning.
But I think you know, I continue to think that's the, you know, the way to kind of approach this environment where valuations improving. You know, you wouldn't say it's like a bargain basement, you know, cheap, where you'd eliminate the dollar cost average plan. You know, when you get into an environment like this, you never know what is the piece of news that changes sentiment in the other direction, and you know, dollar cost averaging just assists with kind of taking that issue off the table.
Yeah, and I think one of the other things that I wanted to highlight, and we've kind of highlighted it, that everyone, my wife doesn't really understand time zones. Yeah. So she when I'm over here, she'll call me at 2 a.m. and it'd wake me up and that. But people who do understand time zones know that if you were at an 8 a.m. meeting this morning, that in terms of Toronto time, right, was 3 a.m.
Yep.
And if you weren't here in London, all your colleagues are here in London working at 3 a.m. Toronto time every day, all around the clock. Oh, and by the way, you've got colleagues in Asia who were up several hours before that. And so the value when you have moments like this where you need to be active, you need someone on top of your portfolio, this is the value, and just all the things we talked about, the way the professional investment manager is wired, which we've tried to show you through Stu and others over the last several years. The advantage of professional investment management, to me, just always shines through, and it shines through particularly on a day like this.
I hope so.
Oh, you hope so? That's not something you're supposed to. No,
No,
he's
no,
like,
I'm just-
you know, the other thing, one of the other things, if you spend a lot of time with investment managers, and thank, but one of the great privileges I have in my role is I get to I get to do that. Is the best ones are not only, again, emotion out, clinical, they're humble too, and understand that this is a really hard thing to do, and it's something that you're not always right. You're certainly not ever perfect, but if you do it the right way, you can really add a lot of value. So anyway, Stu, I know how busy you are today, so thanks for popping down and doing this quick taping.
Great, thanks, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.